Evening, ladies and gents. Simon Brown here, not doing this evening's presentation. That's Berkeley Radenhace. Quick bit of housekeeping before we start. Next Power Hour is going to be 5 May. We've got Wandile Shalobo from Agribiz SA, where he's the chief economist. He will be talking around agriculture locally and globally. It's been booming, but there's some challenges coming, certainly with input costs. He'll give us a sense of that, which will help us understand the agricultural sector in South Africa, both producers as well as the farmers and the allied industries. For example, Carp Agri, who don't farm, but they benefit from when farmers do well. But this evening, we've got Berkeley Radenhace, who is a proper trader. He's got the scars to prove it. He's done a couple of presentations for us over the years. This evening, he's looking at volatile markets, and certainly lots around 2022 that stands out. One of the things that stands out is increased volatility. As always, if you've got questions, drop them into the Q&A box. We've got time at the end for questions. But with that, Petri, over to you.
Good evening or good afternoon, and thank you very much for your time today. Thank you, Simon, for the introduction. And yeah, thank you once again for the opportunity to be able to do this. I think the topic for this evening is trading in volatile markets. It has been it's been a tough time, I think, for most people over the last couple of weeks and months since the onset of COVID. Now almost 2 years ago, volatility has relatively increased on a sort of continuous basis. So we've had to make some adjustments with that, and then obviously over the last few weeks we've seen volatility really sort of creep up again. And generally, higher volatility is synonymous with markets going down. So it's been a difficult time for most, I think, in markets. So I'm hoping to be able to give you guys a little bit of guidance and a little bit of insight on some of the things we can do to try and mitigate the negative effects of volatility. All right, so let's get going. So things we've already covered in the past in previous Power Hour presentations, starting with daily routines, practical trading setups, how to build strategies, trading psychology, risk management, developing a trading plan, and just a bunch of things that I sort of wish I knew before I started. Most of these presentations are available on our website. The link is harenia.co.za/presentations. Once this one is sort of complete, within about a week or so, we'll have this presentation up as well, where the slides will be available, as well as links to the videos and that kind of stuff. I think one of the more important things to say is that there's no real easy way, and I've said this in my previous presentation as well, there's no real easy way of doing trading, particularly if you want to be an active trader. It is hard work, and if you're looking for a quick, easy money, this is definitely not the place to look for it, right? There are definitely easier ways. I think with time, practice, consistency, and a lot of discipline, trading can be something that can you can make success out of, but you have to go in with your eyes open and understand that it's not it's not the easy money that the internet will have us believe it is. In any case, so let's look at the current trading environment as a starting point. So currently, markets have been really challenging, as I mentioned before, right? So over the last 2 or so years, markets have been consistently more volatile. This is, for good reason. There are lots of uncertainties around what the future holds. So inflation, on the back of this massive stimulus programs that basically every central bank around the world have been running over the last 2 years to try and mitigate some of the negative impacts of COVID, essentially, I think is starting to backfire a little bit, because we've printed so much money that inflation is almost the only result that we can expect from here. There's also the risk of further impact from COVID-19, more lockdowns. We've seen that happening in China already, that they've started to lock down more people, in cities and that kind of thing. So that has an impact on supply chains, which again puts inflation pressure on, as well as causes all sorts of demand shock effects, and that of course creates uncertainty, and this uncertainty is essentially what drives the volatility. There's also the Russia-Ukraine situation, It seems as though more countries are starting to get involved. There was some news around Belarus sort of being a staging ground, and you know, the US and all sorts of NATO countries are sending munitions and all sorts of things. So the big risk here is that a third or fourth country starts to get involved in this conflict, and that escalates. Obviously, this has also had quite an impact on energy prices as well as the price of wheat and fertilizer. This is really something I think that we have to be very, very careful of, particularly food inflation. I've said it a few times in sort of interviews and stuff that you know, the words food crisis is something that we haven't really heard much of yet, but I think it is definitely something that we will start hearing in future. There are some, I guess, unconfirmed reports that even local farmers are experiencing an increase of 150% in fertilizer prices, which the retailers are not willing to pay higher prices for the crops, so farmers are not incentivized to plant, which will lead to empty shelves and that kind of thing. So food and energy security has been you know, one of the drivers of a massive amount of uncertainty in the market, and that of course breeds volatility. Further, we have tightening monetary policy, where, you know, central banks are now forced to start raising interest rates, which will potentially have a negative impact on equity prices and that kind of stuff as well. So it seems that we are headed into this global recession type situation. I'm trying, you know, very hard not to make a forecast that we're going into recession, but as far as you know, all the indicators that are starting to flash, like, look guys, we are headed for difficult times. You know, we've had a period where, you know, I've said the retail army is buying the dip, right? So that's become a thing where you just buy the dip, and retail traders, you know, particularly have been using in the US, using lots of call options and that kind of stuff. The question is that, you know, a lot of people buying the dip, and then the dip keeps dipping, which causes panic, and then that exacerbates further downside and higher volatility. So even though we don't necessarily know what the future holds, we do know that it is absolutely a time to be more cautious and very careful in markets, right? A concept that I want to talk about is drawdown. So drawdown is almost this is an inevitable kind of reality of interacting with stock markets or trading or even investing. And you know, our primary goal as a trader, and I actually wrote about that as on the previous blog that was, I think, posted just a couple of weeks ago on Just One Lab. You know, we have to protect our capital at all costs, even if it means that we miss out on opportunities. There's always going to be another opportunity coming along. What we have to do is make sure that we have capital available to us to deploy when great opportunities come. If we miss out on opportunities in the short term, that's okay. Our job is to survive long enough to be able to take the next opportunity, right? So I've put a little chart here. I hope you guys can see the cursor. Put a little chart here that shows, you know, how much, if you lose 10%, you've got to make like 11% to get back to where you were. If you lose 50%, you've got to double your account in order to get back to where you were. If you lose 60%, you've got to do 150% return. So these numbers get bigger and bigger as you draw further and further down on your initial capital. And sometimes, you know, if you've drawn down a huge amount, recovering becomes extremely difficult. So protecting drawdown during difficult times is essentially just way more important than trying to make money in the market, right? If you are disciplined in your approach and you manage to control your drawdown, profits essentially become almost inevitable. It's just literally being able to stay in the game long enough to be able to take the opportunities that the market gives to us. So, all right, let's look at volatility, right? So what I've sort of shown here is we can see over, you know, a long period of time. So starting at 2013, volatility kind of, this is just the Vix Index, the S&P 500 Volatility Index. And we can see that it would sort of range between this sort of 12 to 24 or 12 to 20 region. And this was sort of standard market volatility. We have some spikes here when the market sort of comes down and makes a correction, but generally volatility was relatively low. It even sort of came lower into the 2017, 2018 period. And then along came COVID, right? And we had this massive spike in volatility and a very sharp, aggressive sell-off in the S&P 500. And since then, volatility has not managed to base out as low as it was in previous years. So just as a general sort of market regime, volatility has been a lot higher, which does mean we have to change our approach to this, right? Something that I've also been sort of keeping an eye on, and this is data that includes up to yesterday, is the MOVE index versus the VIX index, right? So what the MOVE does is it basically reads bond market volatility. We can see here that there's a very high correlation between the MOVE and the VIX. Sometimes they're quite far apart, but generally the VIX tends to follow, you know, what the MOVE is doing, right? So as MOVE comes down, we see the VIX come down. What we've seen in recent months is that we've seen a big separation between bond volatility and equity volatility. So there's a lot of pressure on the bond market. People are selling bonds at a furious pace. You know, there's a lot of stuff happening, obviously, with interest rates and that kind of stuff as well, which is pushing bond volatility a lot higher. So one of two things has to happen here. Either bond volatility has to decrease extremely rapidly in order to kind of catch up with the VIX, or the VIX has to catch up to the bond volatility index, right? If the latter is the case, where we see equity market volatility pick up to catch up to where the MOVE volatility is, or bond market volatility is, that implies that we are due for a relatively large scale equity market sell-off. Again, this is not a prediction. This is just basically looking at pure data and looking at historic correlations between the two. They are relatively tightly correlated, and this correlation is now starting to fall apart a little bit, which, you know, rings a few warning bells on this side, saying like, look, you know, we have to be very, very careful. The probability of the market really coming off very strongly in the near term is much higher than it was a year ago. So, you know, keeping this in mind, it's good to be prepared for, you know, what happens. So, as I mentioned, now it's likely to get a lot more bumpy than what it has been over recent weeks. I know that, you know, 3 or so weeks ago we had quite a strong sell-off on the equity markets on the S&P 500, and so we've had quite a strong recovery since then. However, as we've seen over the last week, markets are starting to get a little jittery once more. So, as highlighted earlier, there are still many, many risks, right? Generally, looking at historic data, one thing we need, well, we need three things essentially for recessions to rear their heads, which is we need tightening monetary supply, which is, you know, rising interest rates or central banks putting up interest rates. We need a commodity price shock, which I think we've absolutely seen in the energy market. We've started seeing it in, you know, other things like nickel and copper. There's some evidence that we might have a copper supply shock as well. And then we need runaway inflation. So we need inflation way above what it used to be. And then obviously that sort of reinforces this tightening monetary policy cycle where we have to control inflation in order to, by putting up interest rates. So when these things are present, historically, we've, you know, all these things have been present during recession times. So again, it's not necessarily a prediction, but it is sort of just an indicator that we have to be relatively careful of what we're doing at this stage, right? So we need to adapt in order to survive in this new environment, and we need to sort of prepare ourselves for the potential that we have, you know, higher volatility, aka a market sell-off. So what can we do in order to prepare? Well, there are three different types of participants, at least non-institutional market participants, right? So we're not looking at pension funds and hedge funds and you know, governments and that kind of stuff. We're really looking mostly at the you know, private individuals that are trading markets. So you have investors, swing traders, and day traders. So I suspect that the majority of people watching this would fall into the swing traders category, and the second runner-up here would be investors. The day traders are a very small sort of portion of the market, but we have to find ways to adapt in order to protect our capital, right? So our primary goal here is to protect the capital so that we can live to trade another day. So most of us, across all these three sort of different types of market participants or traders that are out there, a lot of the preparation and a lot of the adaptation that we have to do is very similar. But there are, obviously a few key differences between those types of different market participants. So we're going to sort of start off with the longer term investor, right? So the first thing we can do is we can start to reduce exposure, or essentially just increase your cash holdings, right? So increasing the proportion of cash that you have, or the percentage of cash that you have in your total account or in your portfolio, is going to do two things. One, it's going to lower the volatility of your overall portfolio. It's also going to, you'll have ammunition or dry powder, as the saying goes, so that when the market sells off and gives you a solid buy signal, that you'd at least then have money to deploy to take advantage of the recovery in the market. Because essentially our goal here is to sidestep the pain and have money to invest or capital to deploy when the conditions are favorable once more. So we can see that conditions are becoming unfavorable. We want to get out of the way, right? So some of the things we can do as longer term investors is we can basically sell out or sell down the stocks that are in downtrends. So stuff that we've bought that aren't performing well, now's maybe a good time to reconsider those shares. I mean, in general, go through your whole portfolio, look at the stocks that you want to that you have in there, think whether or not you want to be in them for 5 years. If you are in a losing position, maybe it's time to consider, getting out of those stocks until conditions get a bit more favorable. For example, a lot of the tech stocks have been under quite a bit of pressure. Does it still make sense to hold on to these things, particularly if we're in losing positions? There's an advantage to doing that as well, which is you have nice, tax losses that you can use to reduce your taxable income. So there is advantage in cutting the losers, right? I know it is generally painful and something that particularly the long-term investors don't like to do. But what we want to do is we want to make sure that we are in the stocks that when the market sells off, those shares have not sold off as strong. So we've got a nice reference point where, a month ago, 3 weeks ago, the market sold off really hard. And we can go and have a look at which stocks didn't sell off as hard as the rest of the market. Those are potentially the ones that we want to keep. The ones that sold off, in line with the market or slightly harder than the market, those are potentially stocks that we want to let go of and use, the capital that we free up as the cash portion and in our portfolios, right? So we really sort of just have to relook at stuff. So to give you an example, we run a number of different portfolios for clients. Our local portfolio currently is sitting with something like 20% cash. Our offshore portfolio is also sitting with 20% cash. And then you can see like we've invested primarily sort of in energy, basic materials, and then locally we have some inflation-linked bonds as well. So we're relatively diversified, and we've kept the stocks essentially that have been performing well, and we let go of the stuff that haven't been performing well, right? And this has helped us protect, the accounts from experiencing major drawdown and taking sort of big losses over the last period. So this is a macro thematic approach. So we are, investors of, sort of macro themes. So we're trying to figure out, what we think is going to happen in the world in the next 2 or 3 years and invest accordingly. So this approach is ours. Obviously, everyone's is different. There might be some value guys out there. Deep value is a valid fund, investment strategy, but also, just be mindful of how is your stock performing in relation to the index. If the index is down 1% and the stock is down 4%, maybe it's time to get out. If I know there's a lot of people that are, big fans of Naspers, for example, and Prosus. Those stocks have not been doing really well. If things get worse, do we really think that these stocks are going to outperform the index if they haven't been doing that in the last couple of years already? If there's a large scale sell-off, there's probably going to be more pain for them. And I agree that at some point Naspers and process are going to be sort of a generational, once in a lifetime opportunity, but I'm not sure that that time is, just yet. So it's probably better to, bank your tax loss on those things now, and wait for an opportunity, even if it means you have to buy it at a higher price. But let's wait for the market to really show us that it wants to trend up again, and at that point we can start to get involved again, right? So essentially what we're trying to do is we want to free up cash in order to deploy when the market recovers. So how do we know when the market recovers? So something that has been relatively reliable over the last, well, I guess since I've discovered it and someone showed it to me, it is a very reliable indicator for sort of when the market is bottoming out. It's the Vix Term Structure. So basically what we're looking at here, and just to sort of put as an aside note here, this is not something that is very hard to find information on. For example, if you have an Interactive Brokers account, this is something that is available to you, for free on your Interactive account. So it is information that is relatively easy to find. You don't necessarily need like a Bloomberg terminal or whatever the case is. So what we're doing here is we're measuring volatility over different expiries, right? So volatility futures contracts trade like any other futures contract with a set expiry. So as you can see on this chart here, what we've got basically 4 different lines which indicate to us 1 month ago, 3 weeks ago, 2 weeks ago, and 1 week ago. So the top one here is 1 month ago, the middle one is 3 weeks, this second from the bottom is 2 weeks, and the very bottom one is 1 week ago, right? So what we're looking at here essentially is every sort of dot on this thing is a different expiry. So we're starting with 3-day volatility. So volatility over expected volatility over the next 3 days, over the next week, over the next 2 weeks, over the next month, over the next 2 months, 3 months, and so on into future until we get to 2 years in advance. Now, what happens under normal circumstances, so you can see with 1 week ago, the very bottom one, near-term sort of volatility is expected to be lower than long-term volatility. And this makes a lot of sense to us, right? Because as we go further in time, so this is tomorrow, and this is 2 years from now. So as we go further out in time, predicting what is going to happen becomes more difficult. So of course, implied volatility is a lot higher because it's more difficult to tell what's going to happen, in 3 months or 6 months or 12 months from now, as what it is to tell what's going to happen tomorrow. So tomorrow we can see volatility is expected to be relatively low, but like in a year from now, it's a bit less certain, so volatility is just generally higher. So what starts to happen in times of extreme fear and panic, and we see strong market sell-offs and that kind of thing, is that like if you look at this from 1 month ago, which is the top curve, is that near-term volatility starts to become more extreme than long-term volatility. So this term structure starts to invert. So normally you have this curve that sort of starts low in the near term and moves higher into the long term. When market is sort of really in panic mode, near-term volatility is considerably higher than long-term volatility. So as this term structure starts to pick up, you can see here a month ago, well, let's do this the opposite way around. So let's say we are here today, right? Then, next week, near-term volatility starts to pick up. Then the next week, it picks up again. Then by the time we're sort of at the very depths of the sell-off, near-term volatility is really high. So what we can do is use this as a buy signal, right? So when we see that the Vix term structure is inverted like this, and it starts to flatten, and you see this move that it moves from here down, and near-term volatility starts to dip below long-term volatility again, that's generally a very reliable buy indicator. And if you can look at a month ago, volatility was extremely high in the near term, and if you look at what happened to the S&P 500 and even the Aussie, the market came off very hard during that time. Now, however, well, at least a week ago, near-term volatility was very low again, and that term structure had kind of returned to its normal configuration, and that sort of, is now that the market has been bouncing. So as you see this move down in the space of 1 week, that near-term volatility really reduced a whole bunch, and it sort of dipped below the longer-term volatility again. That is your indication to, okay, I need to get involved. And if you bought S&P 500, for example, 3 weeks ago, you would have had a very, very good run up to about a week ago. So we're looking at a week ago's data. If we look at yesterday and today, this sort of term structure is starting to flatten out again a little bit, which shows us that, look, the market's taking strain and there's a little bit of panic coming in. So essentially what this is going to be is this is going to be our buy indicator for when the dust settles. Like, how do we know when to buy and redeploy the capital that we've freed up now? It's going to be when this term structure goes from inverted back to flat and then back to normal, right? Right, okay, so for the swing traders, what we can do, and it's really sort of just simple stuff, right? We need to make sure that we trade bigger. We trade smaller. The daily ranges on shares are going to be bigger. So the swings that we see, the share price movements that we're going to see on any given time or on any given day is going to be considerably bigger. So we have bigger percentage moves, and therefore we need to reduce the size that we trade and probably widen the stop losses that we use in order to accommodate for this additional volatility. There are two different ways that we can look at how to manage stop losses. Well, there are many different ways, but two ones that I like to use. One is a bit more complicated than the other. The one is the ATR times 2 trailing stop loss methodology, and the other one is a 3-day low trailing stop. So you can also use a 3-hour low depending on the time frame that you entered the trade. So if you are a trader for an hourly chart and you want to use 3 hours, if you trade for a daily chart, you want to use 3 days. Whatever the case, whatever the period that you're using to do your analysis is, you use 3 periods prior the low of that period as your trailing stop loss. I'll give you an example of how that works in a moment. We just have to remember that trading, really swing trading, particularly day trading, is about survival, right? We need to make sure that we're around to play the game again tomorrow. So drawdown is this unavoidable reality that we can't get away from. But simultaneously, we only really need 1 or 2 good, really, really good trades to make our whole year, right? If you, for example, bought Tungela at 80 Rand, you're up 200% on that position, right? So that one trade can really make a big, big difference to your overall profitability. Obviously, we need to avoid taking risks that we can't afford, and we need to understand the risk that we are taking on. Also, in one of the previous presentations that I've done, that you can go look at, I suppose, is to build a nice model for yourself that has multiple confirmations, right? So you kind of want 1 or 2 momentum indicators, as well as confirmation of trend and maybe a break of resistance, so that you can have not just one technical reason, but maybe 3 or 4 technical reasons. So let's say, for example, you want it to be an uptrend, you want your stochastic to move into a bullish configuration, you want your RSI to move into a bullish configuration, and you need the stock to be relatively stronger than the index. All of those things need to be confirmed before you can take a trade. So you need to be a bit more selective about the trades that you take. I want to just also explain a little bit about how the ATR times 2 stop loss works. Just for reference sake, I think some people might not have seen the previous presentations on this stuff. So essentially, when you enter into a new trade, you start with a regular hard stop loss in accordance with your 2% rule or whatever it is that you're using, and then you can take the ATR reading on the time frame of your entry. So for clarity, like what the ATR is called average true range. It's an indicator that is available on most trading platforms. It basically measures the range that a share trades, and it averages that out over a period of 14 days, and then that prints a data point called average true range, and that plots an oscillator as an indicator at the bottom of your price chart, right? So generally what you do is you say, okay, cool, ATR multiplied by 2, that's where my stop loss is supposed to be. So if your stop loss is at first at a hard stop point, for example, at a technical trend change inflection point on the chart, that's where your stop loss is. And as the trade moves in your favor, eventually this ATR times 2 calculation will start to move your stop loss higher and higher and higher. And every day you do this calculation, or every hour, or whatever the case is, you can build yourself a fancy spreadsheet. We have one available if you want to download it, that can show you where your stop loss should be and whether or not you should be adjusting it. So as every period passes, every day or hour or whatever your time frame is, the ATR will change, average true range will change, and therefore the distance between the last sort of traded price and where your stop loss should be will also change. So as the market moves in your favor, you only ever move your stop loss higher. Sometimes what will happen is you might see a bit of a compression in the trading range that the stock is going through, which will tighten the ATR. If that ATR tightens, you can move your stop loss higher. But when there is a big sort of volatile move and the market breaks out, let's say it breaks higher in your favor, you don't necessarily want to be widening your stop loss at any point, right? So, okay, let's get into sort of an example of how this works. So what we have here is, let's say we've got a share price that's kind of trending up and you want to take a short position here, right? So when we take our initial entry into the short trade here at, say, 108 Rand and 8 cents, we're going to put our stop loss at 109, right? 109 Rand 80 cents. So that is where we think, from a technical perspective, our stop loss should be, because if it goes above 109.80, then we can say the trend is on its way up again, right? So the risk we're taking here is essentially 87 or 86 cents. And our ATR at this point is also, or ATR times 2 also works out to 86 cents. So then as the market sort of comes down in our favor, we want to be able to trail our stop loss lower. So as the market sort of comes down, here our ATR keeps dragging down our stop loss until eventually the market turns and we take our stop loss there. So in a sense, we don't necessarily have to put a target on this trade. We can only use our ATR times 2 as our indication to get out of the trade. So as the market sort of goes down and volatility might increase in the stock, ATR might increase, which will mean that our ATR stop loss gets wider. But as long as price is moving in our favor, and we're only ever moving the stop loss if it moves in our favor, we should be able to trail that down quite well to a point where eventually the trend changes and we get out, right? Another example here would be, here we have a situation where, this trend doesn't necessarily change, but our ATR stop loss drags us all the way down to here. Our stop loss sits here. It doesn't necessarily break higher. It continues to trade down. And at some point, we have a situation where ATR starts to compress. So as this market sort of flattens out again, ATR starts to compress. This ATR times 2 calculation now comes to a much smaller number. If we have a breakout higher, we know where to stop. If we have a breakout lower, our ATR stop loss, trails down again. So this is a very nice way to do this. Okay, this is an example with a short position, but it's a very nice way to make sure that we stay in the trades that are winning and we get out of them at the most favorable possible time. Another method is the 3-day or 3-period low. So a good example here is Tungela Resources. We had a nice little breakout here. Essentially, all you're doing, and this is just really keeping it extremely simple, is you're saying, okay, cool, this is today's candle, yesterday's candle, 3 days ago. The low price on that candle is our stop loss. So today's, tomorrow we'll move our stop loss up now to 220 to sit at the low of that candle. And if we break lower, then we, below that level, then we stop out. Otherwise, we just let this trade run. There's no real reason to make any adjustments, to our position. There's no real reason to have a take profit on this trade. We can just let it run until we get trail stopped out. So this is a very nice way. I think at least it's my preferred way of managing risks or stop losses and targets and that kind of stuff. And then lastly, looking at the intraday trading stuff. I mean, the rules are fairly similar to that of the swing trader. Very much just reduce your positions, be a bit more mindful that stocks can move a lot higher. The real superpower that you have here is that you're not holding overnight positions, so you get to start every day afresh. So there's none of that sort of overnight position holding stress. And it's just, whatever methodology has been working for you, don't really change it. Volatility can be a great opportunity for you to as an intraday trader, because if the moves are bigger, obviously you can make slightly larger profits. But you need to also be a little bit more patient with how your when you take your profits. And if things are moving a lot, then you might want to sit in your trades a little longer to give them a bit more time, and this is where a trailing stop loss will be a bit more helpful. So essentially, the major rule here, and I'm going to reiterate this again, is you have to protect your capital at all costs. So the primary thing that we want to do is to make sure that the shares that we are, if we're investors, that we are invested in, are still the stocks that we want to be in, and to have, potentially look at the positions that we are not too comfortable with, reduce those positions, free up some cash, and then when we see a solid buy signal looking at something like the Vix Term Structure, that is when we want to re-enter into the market. And that, ladies and gentlemen, is all I have. Well, I'm now sitting in I don't know where Simon is. I'd like to do, I'm hoping that you guys have quite a few questions to maybe work through.
There we go.
Around
my internet was dying. No, I'm back. My internet is deeply struggling here.
All right. Is there a way that we can see?
Cool, folks. If you've got questions, I've had one or two pop up on the Twitters. Petri, the one question coming through was that. So, are you hearing me?
I am a little broken, but I am.
Okay. No, my internet is struggling. I'm going to move on to my backup. The one question was offshore versus local. Do you preference one over the other, or is it a case of just where?
Oh, okay, I didn't get the last part of that, but preference one over the other. I think
opportunity sits, you're happy to grab it either way.
Yeah, I think that's basically the way that I think about it. Is the advantage of the offshore world is that generally trading costs are somewhat lower than they are locally. And also that there's just a wider variety of things for us to choose from, right? But conversely, if you look at stuff like fund flows and the like, we've seen that there's been a huge amount of disinvestment from China and obviously from Russia, and there's a lot of sort of money managers and funds and stuff out there with emerging market mandates, which then are forced to stay invested in emerging markets. So a lot of those flows are coming into South Africa. So there's big opportunities here at the moment in the emerging markets. So I think the key is really to just kind of look at where the opportunities are and follow the money, right? So there's no real true preference as long as the companies or the sectors that you're investing in are of high quality.
No, fair point. Tyler's asking the stop loss for the 3-day candle. As it moves, you're basically adjusting that stop loss a day at a time, assuming it's moving in your direction. Every close of day, you say, cool, so a new candle comes along, you're now going to adjust it day by day.
Correct. Yeah. So you don't want to adjust your stop loss. Well, so it depends. So if you're using a daily chart to make your decisions, then you don't want to adjust your stop loss on an intraday basis. If you're using an hourly chart to make your decisions, you don't want to adjust your stop losses intra-hour. Where there could sometimes be, a bit of whipsaw, if you will, is if you have a situation where on an intraday basis the market trades below your stop loss and then closes the day above. Then you might get stopped out for nothing, as the saying goes. Like a good example would be in this consolidation period here, where you can see that little candle has got a little red arrow, made a low, was the lowest point in this little recent range. So if you had a 3-day stop here, you might have been taken out there. And if you got long around here somewhere, that might have stopped you out. So you have to use a little bit of discretion. You know, I like to sort of say, like, you know, what you can do, which is sometimes relatively safe, is to say, okay, fine, if I get a stop loss that gets triggered throughout the course of the day, and I'm using a daily close as or a daily candle, I don't actually want to stop out. I would, like, if I get a stop signal and the market looks like it's going to close, obviously you can look at indicative uncrossing price during the closing auction, and if the market is going to close below your stop level, then you trade your stop loss in the auction. So you have to use a little bit of discretion there. So in this case, with this little candle here, that would have saved you. But that's not necessarily always possible for you know, for everybody who isn't able to sit at their screens all day. And also you have to be quite mindful of what's happening in the macro environment. You don't want to be doing that on this day, thinking, well, you know, I'm not stopping out, I'm waiting for the close, and then the next day you missed your opportunity. So whatever your sort of methodology is that you pick, like I said, okay, if I put my stop there, it's a hard stop. If it trades down through that level during the course of the day, I'm out. I think something that took me a very long time to learn is that it's okay to sometimes miss opportunities, right? I can always get back in. For example, if you got stopped out needlessly on this little daily candle here, and let's say you sort of got in around the 80 Rand level or the 70 Rand level, and you now get stopped out at 80, you know, that's unfortunate, but you can then, again, you can see there's a nice little ranging setup here that breaks out. There's a new opportunity for you to get in, right? I think one of the things that particularly swing traders do is we try to hold on to our positions too much. And I think that, you know, it's a balancing act between the more I trade, the higher fees I pay. You know, brokerage is not exactly, I mean, it's, you know, it's a fraction of a percent, I guess, but it adds up, right? So you want to reduce those fees as much as you can by not trading too much. But simultaneously, we forget that, you know, what we sometimes do is we get married to this idea of, you know, I don't want to pay brokerage and I don't want to, you know, overtrade and this and that. I'm just going to hold on for a long period of time. We can always get back in. You know, it's better to sort of manage risk first and then you know, worry about the rest later. So in this situation, yeah, absolutely, stop out, be patient, don't chase it when it comes in here, wait for it to sort of, you know, formulate a range again, which is kind of exactly what it did, and then that gives us another opportunity down the road. So that sort of patience, I think, is the most important key, or the most important thing to this whole sort of, you know, thing that we do called trading, right? There's two types of things that happen. Is either we overtrade and we sort of, you know, want to trade everything that moves, or we sit with positions for way too long and we don't, you know, we refuse to accept when we're wrong because we have some sort of a cognitive bias that's working against us. So yeah, in that situation, you know, don't be afraid to get back in if there's another valid setup for you to trade. And you know, if you're trading on a daily chart, absolutely, you know, at the end of the day, so with Tangela, I'm not sure where it closed today, but you know, tomorrow, you know, that stop loss now moves to 220. And if it trades below 220, then you're out.
And I take your point very much, and it was something that took me time to learn, is that when I get out, is to, you know, be happy to get back in. I was like, I'm out, I'm done, but truthfully, actually, be happy to get back in. Tangela closed 233.77. That thing's a beast. And that's one I messed up. I sold on that run and then took the money, and I should have got back in at the very least. Question coming through from Jitendra. Great question. Good to trade indexes and move with sector rotation. So I'm going to give a quick short answer. I trade indices, and in a sense, I pick up that sector rotation, but I'm not doing it by, I'm just looking at the chart. And you know, there was a period of about 6 years where it was all about the Indy, because you were being pushed by SAB, by Richmond, by Naspers, and all of those big stocks. I haven't traded the Indy in an age. Globally, it's you know, there's some markets which just go, you know, quiet, or sectors that go quiet, and then I'm trading the others. So it kind of self-selects. But Petri, do you kind of take a top down and say, you know, energy is a space we want to be in, let's focus on energy and perhaps ignore one of the other sectors?
Well, there's two sort of ways of thinking about it. There's this macro thematic way where you kind of look at just macroeconomic data, and you select your sectors based on that. So energy is obviously a big theme for us now, for the time being, because there's a lot of fundamental things that point towards energy scarcity. And also the next, I'm kind of looking at copper, as well as rare earth minerals and rare earth elements and that kind of stuff. That's for sustainable energy production and storage particularly, but also food production, right? So the price of food is something that I think is going to be going up quite a bit. So that sort of macro thematic way is one way of looking at it and picking your sectors based on that. Another thing that you can do is on TradingView as well, is there's an indicator. It's a custom indicator, so you might have to fish around to find the one that works. There's one particular one that I know works really well, and I can't remember the name. I think when we put the when the videos are published and stuff, we can maybe just put the name of that indicator there that somebody built. It's called a relative strength comparative indicator, so RSC. It is different from RSI. So the relative strength index obviously measures one stock itself. A relative strength comparative basically takes an individual stock and it divides it by another stock. So what you want to do is, if you look at sectors, for example, so you can look at the Indy versus the All Share Index, or the Indy versus the top 40, gold mining versus the top 40. That's quite a nice indicator to use because it shows you relative performance between the two. So if you put that RSC on and you slap like an 89-day moving average on that RSC, if the RSC indicator is above the 89-day moving average, you can argue that there's relative outperformance, and then you can build yourself a ranking table off the back of that. So you want to be invested in sectors, at least, that are relatively outperforming the index over at least 3 months. So you can use that RSC as an indicator of which sectors you should be paying attention to and which sectors you should be, getting out of the way of.
Yeah, I like that, and it gives
I wonder
you that,
if I can,
indication.
I'm going to quickly, I'm just going to stop my screen share for a second so I can see if I can pull up a chart on TradingView here. I'll be back in this. Is that okay?
Yeah, cool.
Okay. Let's see if I can do this. How do I end slideshow? Oh, wow. I'm not letting there we go. Give me my pointer back. Indicators.
Question coming through, P3, quickly in a moment while you're looking for it there. Do you trade FX?
No. No.
No, me neither. You know what?
Yeah.
I've made some money trading FX. Overall, I mean, maybe I'm a little bit ahead, but I mean, there's so much I don't like about that market, aside from the fact that it's just humongous. When JP Morgan, they get their 5 best traders, they give them $100 million and they say trade FX. They don't go and trade, Thungela or anything like that. And the 24-hour, and so I largely stay well away.
Yeah, I think there's a lot of excitement around the and it's also marketed really, really well, right? But the truth is that the major problem that I have with FX is there's just excessive leverage. So if you take, for example, a normal CFD account, you then you get generally 10 times leverage on that. But when you look at something like Forex, you're generally running like 50 times leverage on something like that, which is
I mean, some of those folks out there are offering 1,000 times leverage, which just means that you cross the spread and you die.
Yeah, basically. All right, let me quickly see if I can show you this.
Cool.
You should see my screen again.
Yep, we got it. We got your screen.
All right, cool. So this is basically just the S&P 500, right? So this RSC, the indicator that I'm using here, is called relative strength. This one by Chucky Nation. right? You can see 337 other people are using it, right? So what you could do here is you just put your comparative index in. So you say SA 40, South Africa 40 index. Okay, go. And you might want to change your comparison period. You want to make this 90 days. Well, actually, no, you want to make this 500 days, and you want to make this 89 days. Say, okay, cool, bang. So now we can see here that the S&P 500 is actually relatively outperforming the Aussie, but it hasn't been since November to very early or very late March. The Aussie has been outperforming the S&P 500, which we know is true, right? So now that this is kind of like starting to outperform, we say, okay, cool. S&P 500 is maybe something we want to be invested in. So let's look at if we use like a stock, let's say BHP Bulletin. I know it's not BGH, eh? Or BHG. What is BHG? So let's say Bulletin. It's going to take a while to load. Is it? I don't know. Let's use TCP. Transaction capital. Cool. So we can see here that transaction capital has long periods of relative outperformance versus the index. And even here, sort of early March, we can see that there's been a very, very strong relative outperformance versus the South Africa 40 index, or the top 40 index. So we're using 500 days with the data. We're putting an 89-day moving average on it. And we can see, okay, cool. So when this is a stock that if the market gets a bit wonky and volatile, this is one we can keep, right? Then you compare that to something like Process, right? You can see here that Process is by far underperforming, because there's our moving average there, by far underperforming the top 40.